For 30 years, the global economy moved in lockstep. When the US sneezed, the world caught a cold. That correlation is dead. Look at this chart, this split right here. This is the 2026 divergence. On one side, an aging West facing a debt crisis. On the other, a Capex-fueled India entering its prime. If your portfolio is still allocated for the world of 2020, you are about to lose money. Global gloom. Let's start with the bad news so we can get to the opportunity. The global economy is tired. According to the latest data from UNCTAD in the IMF, global GDP growth for 2026 is projected to be stuck in the mud at roughly 2.6% to 2.8%. Why? Because the bill for the last 5 years of easy money is finally coming due. In the US, the soft landing versus hard landing debate is over. The reality is a low-growth grind. Debt servicing costs are eating into productivity. In Europe, Germany's industrial engine is stalling out due to energy costs and aging demographics. And then there's the China factor. For years, China was the world's factory. But look at the numbers. Their growth is cooling to around 4 to 4.6%. They are fighting a massive property crisis and the classic middle-income trap, where an economy gets too expensive to be a low-cost manufacturer but hasn't innovated enough to be a high-tech leader. Investors are scared. They are looking for safe haven assets, but the traditional ones, like US Treasuries, are losing their luster as de-dollarization chatter gets louder among BRICS nations. The US dollar collapse isn't happening overnight, but its dominance is bleeding out, slowly. The Indian engine. Now, look at India. This is where the divergence happens. While the world struggles to hit 3%, India is projected to grow between 6.7%, Goldman Sachs, and 7.5%, CareEdge, in 2026. That is a massive growth gap. What is fueling this? Two things: the Capex cycle, India, and the demographic dividend. Let's simplify Capex. Think of it as a business renovating its shop to sell more goods later. For a decade, India didn't renovate. Now, the government and private companies are spending billions on roads, railways, and factories. This creates jobs, which creates income, which creates consumption. It is a virtuous cycle. Unlike China, whose population is shrinking, India has the world's largest working-age population. This is the demographic dividend. Millions of young people entering the workforce, earning, spending, and investing. This domestic demand is a shield. It means that even if the West stops buying, Indians are buying enough to keep the engine running. This is why the emerging markets opportunity is actually just an India opportunity in disguise. The winners. So, where do you put your money? If the Nifty 50 outlook is bullish, which sectors will lead the charge in 2026? First, manufacturing. The PLI scheme benefits, production-linked incentive, are fully kicking in by 2026. This is free money from the government for companies that make things in India. We aren't just talking about mobile phones anymore. We're talking about defense, specialty chemicals, and heavy machinery. Second, banking. You cannot have a 7% GDP growth without banks lending money. Indian banks have cleaned up their books. Their non-performing assets, bad loans, are at historic lows. They are lean, mean lending machines ready to fund this Capex boom. Third, green energy. India is hungry for power. The shift to solar, wind, and green hydrogen isn't just about saving the planet, it's about energy security. This is a sector receiving massive government support. The risks? We have to be realistic. India imports most of its oil. If global crude spikes, it hurts. And if the US enters a deep recession, our IT exports, the tech support of the world, will take a hit. But these are speed bumps, not roadblocks. The action plan. Here's the bottom line for your portfolio. 2026 is the year the global economy splits. The West manages debt, India manages growth. If you are looking for the best stocks for the next decade, look for companies building India's backbone: infrastructure, power, and banking. Don't try to time the market. The Nifty 50 outlook isn't a straight line up. There will be volatility, but the trend is undeniable. This is the Great Divergence. You can either be worried about the global slowdown, or you can be invested in the Indian growth story. The choice is yours. In a market full of noise, clarity is your most expensive asset. If you found value in this analysis, hit the like button and subscribe our channel.